There's a very high level of complacency. There is no risk in the markets right now. There's no concern. Any dip to the 20-day moving average gets bought. This is just a function of that more extreme bullish sentiment. And here's what you need to know before the bell this morning. The Bernie Madoff Trendline remains exactly in place. You know, we had this sell-off on Monday and Tuesday. And then, of course, yesterday, the market came down. And I mentioned this yesterday morning. I said we were going to open a little bit weaker. We were going to touch that 20-day moving average, and we'd see if the market would bounce, if those computer algos would kick on and start buying stocks. And they did. Had a very nice bounce right off that 20-day moving average. This morning, futures are pointing higher. NASDAQ's up about 100 points right now. The S&P's up about 21. So again, this perfect Bernie Madoff trend line is remaining very much intact. Anytime the market drops to the 20-day moving average, computer algorithms kick on, start buying that dip, and that's what we're seeing here once again. So again, there's very little to be concerned about, and unfortunately, it's just one of those very boring markets that we're in. I wish I had more exciting news to tell you, saying, oh, this has happened, and eventually we'll get there, but right now, it's just basically every dip to this 20-day moving average is just your opportunity to buy some more stock. But now, having said that, bullish sentiment is very, very high. There are, I actually put out a tweet this morning talking about the fact that bear sightings are now extremely rare. There are very few bears in the markets right now at all in terms of investor sentiment. Bullish sentiment is extremely high. And something I'm writing about right now for next week, margin debt is back on the rise as well. Now, again, margin debt is important to a rising bull market. So as people begin to become much more bullish on the markets and begin to leverage their bets, they take on margin debt to do that. Well, that's more buying power, right? Because I'm borrowing money to buy stocks. That is supportive of rising asset prices. And again, we're seeing that right now. We've seen a lot of movement into options, very bullish option strategy right now. Volatility Index remains extremely low. In fact, we saw just a brief moment earlier this week where volatility looked like it might be turning up, but again, that didn't happen. In fact, over the last 2 days, volatility is dropping back down sharply again. So we had this very small spike in the volatility index that failed to really materialize. And again, complacency has just come set back right in here. So again, there's a very high level of complacency. There is no risk in the markets right now. There's no concern. Any dip to the 20-day moving average gets bought. But again, this is just a function of that more extreme bullish sentiment. We're seeing it across the board, whether it's in institutional investors, which are now leveraged. As of last week, they were at 103% on their equity allocations. The American Association of Individual Investors are some of their highest level of allocations since the dot-com crisis. So again, no matter kind of which indicator you want to look at in terms of bullish sentiment, allocations and positioning, whatever it is, they're all extremely invested in the market. In other words, everybody's in the pool right now swimming. So the only question is when the tide comes out, who's naked? That's who we'll find out about. But that's what you need to know before the bell this morning.